So let's talk about the US dollar. What has the US dollar been doing? So US dollar is basically we see the representation in the dollar index, which is nothing but a basket of currencies against the US dollar, and that signals whether the dollar is getting stronger versus other currencies or weakening versus other currencies. It started at the index of 100 and today it is at 99. In the last few months since calendar year 2025 started, we have declined almost 10% from the top, and this major support here is getting broken as we speak. Now the expectation that many people have is that the dollar is going to tumble back to at least the pandemic levels, somewhere near 90, 88, 90 levels, or 1991. Morgan Stanley is predicting US dollar index to drop to 91 by mid 2026. Uh, and this is basically driven by the administration's attempt to reduce the dollar strength versus other currencies, because once you reduce the strength of your currency, you are able to export more to other countries. Right now, US is majorly importing, and they want to set up manufacturing there. They want their currency to be such that other countries should be able to buy American products, and that will only happen if US currency becomes cheaper than where it is right now. So US growth is currently slowing down. They really need to press the pedal now. So aggressive Fed rate cuts is what uh, can be expected. 175 bips is expected, and this is all coming when there's already sort of huge waves of deglobalization going on and all kinds of supply chains breaking down. A lot of demand getting looking inwards into the each pocket of the economy. So like China is more now looking at domestic economy versus growing outside. Similarly, US also wants to grow its own economy while also remaining uh, converting into an export-led hub, manufacturing hub. Now, all that looks very, very difficult to happen, at least in the very, very short term. Because you want the cake and you want to eat it too. That is the situation that is happening. So you want your currency to go down, but you also want to remain the reserve currency. So this is now these two things are at crossheads where both cannot really exist. If we see the last 30 years of data, and this chart is from Crescat Capital, you can see this red line here. This is the dollar index for 2025 so far. So 6 months, almost 6 months in, and this is the full year for the last 25 years. You can see the current year has been one of the weakest years for US dollar in the last 30 years. Uh, so we've had some positive years, some negative years, but we currently are looking on a very, very poor trajectory, possibly a double digit or more decline during this year by the end. Dollar short positions from this chart from Bloomberg also shows highest since 2023 dollar short position. So people are expecting that the dollar index is going to go down, and the bets are being placed accordingly in the markets. Now, as dollar index declines, other currencies are likely to, correspondingly go up. So Euro USD could be rising from current 1.13 to 1.25 as per Morgan Stanley, and the charts are also looking as if they are very, very strong for these currencies. So this is Euro to US dollar. This is Japanese yen to US dollar. You can see that it is sort of basing here and about to kick off. You also have the British pound, which is amazingly getting strong versus US dollar. Just some time back it was almost at parity, and now we are at 1.35. So these are very big moves when you see from a global perspective. Now, this is all very much tied into the US yields. So US 10-year yield, the bonds in the US treasuries, uh, is likely to dip as the Fed wants to cut rates, but it is not dipping right now. Two cuts have already happened by the Fed, but the rates have not dipped. So the bond market is defying what Fed wants to do. So in normal times, the bond market will follow or at least lead uh, the what the Fed intends to do. The Fed is intending to cut. The bond market usually will precede that, or at least go in line with that movement. But right now, what is happening? Fed is cutting, but bond market is not going down. So it is like almost like saying that bond market is calling the bluff of the Fed that you can't win this game. But still, there are analysts who predict that yields will drop from 4.5 to nearly 4% by end of this year, and rates can go down by 175 basis points. If that were to be achieved, it would mean that a significantly loose monetary policy, basically putting a lot of stimulus into the market, a lot of money printing getting it done, basically buying a lot of bonds. When you buy bonds, bond prices go up and yields will go down. So you basically, if you start buying your own bonds, Fed prints money and buys the government bond, they can engineer the yield to come down. The only repercussion of that will be that if it is engineered to come down, the yield, the bond buying will create a lot of liquidity in the system, and that may fuel a lot of inflation going forward. Another way to look at this is from this tweet from Tavares. There's a correlation between USD and 10-year yield that is being tracked here. And it says that whenever we've had 10-week correlation of dollar index with US yield come down to such levels, it has not been so great for stocks. So this is also pointing towards not so great news for stocks going forward. We've had two episodes where, for long periods of time, stocks really, did not trend much, and that perhaps may happen going forward. This actually does not mean that it is going to impact all markets similarly. We are just talking about the U.S. markets here. So what about the Indian markets during dollar downtrends? So if you look at some past data, uh, there are three phases in which we've analyzed this data. So January 85 to August 92, to 7.5 years period, dollar index collapsed by 50%. And during this period of 1985 to 92, you saw the Sensex in dollar terms go up 416%. Arshad Mehta also peak happened during this period. 416% in dollar terms was the gain in Sensex, whereas S&P 500 in dollar terms obviously gained 156%. So whenever you will find that dollar index is collapsing, US stocks may or may not do so well, but emerging markets are likely to do very well because the money is sort of moving out of the dollar into other markets. And at the same time, if we look at gold also went up 158% at the same time period in Indian rupee terms. So whenever you will have dollar index come down, it will be great for Indian stock market. It will be great for gold. These two correlations we can make out from here. The second such phase happened from January 2002 to 2008, about 6 years plus, where dollar index fell about 40%. Here also you can see Sensex went up 380% and gold went up 162%. So again, the period where the dollar index collapsed, it was great news for Sensex, it was great news for rupee gold. And even in dollar terms, if we one were to see in the second phase, you can see that Sensex went up 450% in dollar terms versus only 16% on S&P 500. So whenever dollar index is collapsing, US market will not do so well. Indian market is likely to do very, very well. And we did a very detailed video on the impact of weak dollar for India some time back. This is a video. I'll put the link in the descriptions. Please watch this video if you would like more details. So this is where we are. We are, as I mentioned, let's go back to this chart, that this is looking like a third phase down. I don't know how far it will go down, but it could be a major phase down for the dollar index. And that may be the reason for some great performance in either Indian markets, not either, both Indian markets and in Indian rupee gold. Let me know in the comments how you think a weak dollar will impact the world. It will be a great discussion to have there. Thank you so much for watching this. Do like and share these videos and do subscribe to the channel. Thanks. Bye.